Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. This is N Muchai, your Accounting Made Simple tutor. Once again, I want to welcome you to our class. Like I've already said, ensure that you subscribe, like, share, hit the notification bell. That is the only way you can support us to support you. That's the only way you can support us to support you. This we've done for the last 15 years, and we want to be of help to you. Kindly help us also to be of help to you. Now, like I've said over and over again to my students over the years, that most of the exams, you will very rarely find an exam without theory. You very rarely find an exam without theory, and many students concentrate on the computations. And they forget theory. And if you look at CASNEB exams, and many other, I've taught students studying ACCA and many other courses. And in each one of them, you always find usually between 25 and 40% of the marks are usually theory. You miss the theory, and the theory is 30 marks. It means you'll be trying to pass out of 70 marks. If you miss, if the theory is 40 marks, it means you'll be trying to pass out of 60 marks, and you are actually creating your recipe for failure. So as much as you are teaching our computational part of accounting, it is very important that you also learn the theory. And today, I want to teach 15 reasons why we provide. 15 reasons why we provide for depreciation in financial accounting. 15 reasons why we provide for depreciation in financial accounting. I have seen this asked and tested over and over again, and I've seen my students score 0. They are very good. They prepare themselves very thoroughly in terms of the computations of depreciation, the trading, the disposal, the property, plant, and equipment movement schedule. But when you are told, give us 5 reasons, give us 6 reasons, and each of them has 2 marks. Imagine you have been told, give us 5 reasons, and each of them has 2 marks. 2 times 5 is 10, and the question is out of 20, you have lost 50% of the marks if you don't know the reasons. And the first reason, I will move a bit fast, is to allocate the cost over useful life. It is to allocate the cost of the asset over its useful life. I like reminding our students that there is a very big difference between an expense and expenditure in accounting. There's a very big difference between an expense and an expenditure in accounting. An expense is what has been consumed, used up in the farm. But expenditure, you can spend 2 million shillings to buy a motor vehicle, but it is only a portion of that motor vehicle that will be used in the course of the year. And that is what will be allocated as an expense. It has been used. We have bought and we have used. The portion of that vehicle which you have bought and we have used, we call it depreciation, and we are saying it's supposed to be allocated over the useful life of the asset. We are saying if the asset is 2 million and we believe it will be used for 4 years, you divide 2 million by 4, you get 500,000. The 500,000 is allocated every one of the years we are using that vehicle if we are using the straight line method of depreciation accounting. Now you're saying depreciation helps in spreading the cost of a fixed asset over its useful life, ensuring that each accounting period bears a fair portion of the asset cost. Instead of charging it all once when purchased. I've seen many students, you're telling them to prepare an income statement, And they assume that because we have spent money buying the asset, they bring the asset in the income statement as an expense. No, it's not an expense until it has been used up. Until it has been used up, and we are saying depreciation helps in spreading the cost of that asset over its useful life, ensuring that each accounting period bears a fair portion of the asset's cost instead of charging it all at once. That ties up to number 2 reason, to match cost with revenue in line with the matching principle. To match cost with revenue in line with the matching principle. What does the matching principle state? The matching principle states that we match revenues with the cost that helped to generate those revenues. Once you get the revenue that you have made, you must always ask yourself, how much has been consumed in the course of generating this revenue? How much have we incurred in the course of generating that revenue? And that's why we talk about the matching principle. You match the revenue you have made in the course of the year with the expenses you have incurred in the course of the year. And one of the expenses you incur, it is the loss in the value of non-current assets, which were used to help us to generate revenue. The matching concept states that we match revenues with the expenses that have helped generate the revenue. So we are saying, under the matching concept, expenses must be recorded in the same period as the revenues they help to generate. Depreciation ensures that part of the asset's cost is charged against the income it helps to earn each year. Number 3, to show the true and fair view of the financial position. You know what the financial position is? We prepare at the end of the year a statement called the statement of financial position. We are asking ourselves at the end of the year, how much assets does the firm have? How much non-current asset does the firm have? How much current asset does it have? And how did we finance those assets? How did we finance those assets? How much of that money came from the investors or the owners of the firm, and how much came from liabilities? And we are basically saying, if you do not deduct depreciation, if you do not deduct the depreciation, the value that will be presented in the balance sheet will be the original purchase cost. But if that asset has been used for a year or 2 or 3, the original purchase cost cannot be the correct value of the asset. And therefore, the true and fair view of the financial position will not be accurately presented by financial statements where the assets, non-current assets, have not been reduced with the depreciation or the loss in the value of those assets. So you're saying, if depreciation is not provided, assets will appear at inflated values on the balance sheet. Because if we have used it for 2, 3, 4 years, its value is not the way it was when you were buying it. Depreciation ensures that assets are shown at their net book value, that is, cost less accumulated depreciation and impairment loss. Assets minus the original purchase cost of the asset minus the accumulated depreciation and impairment loss that you're going to study as we progress in accounting. That is what helps us to reflect a true and fair view. Number 4, to comply with international accounting standards. To comply with the international accounting standards, and we know that International Accounting Standard 16 talks about accounting for non-current assets, that is property, plant, and equipment. So International Accounting Standard 16, such as International Accounting Standard 16 on property, plant, and equipment requires depreciation to be provided on tangible fixed assets, ensuring compliance with professional accounting regulations. Number 5, to provide for assets replacement. Every time you depreciate, you deduct the depreciation expense from the profit so that whatever is left, remember, all the profit that is made after deducting the expenses and after deducting income tax, that profit can be distributed to the shareholders as dividends. But once we deduct depreciation, we are retaining some of the profits in the firm to help us in the future to replace the assets we are depreciating. And that's what we are saying here. Depreciation acts as a fund for replacement, allowing the business to accumulate enough resources to replace the assets when it becomes obsolete or worn out. It reduces the profits. It reduces the profits to ensure that adequate profit is retained in the firm. It is not distributed to the shareholders as dividend. It's retained in the firm to help us replace the assets when it becomes obsolete or worn out. Number 6, to avoid overstatement of profits. To avoid overstatement of profits. If we don't deduct depreciation, our profit will be overstated. We will understate the expenses and therefore overstate our profits. And we are saying without depreciations, profits would be overstated, as no allowance will be made for the reduction in value of fixed assets. Depreciation ensures the profit figure reflects the true operating results of the firm. Number 7, to reflect the asset wear and tear. To reflect the asset wear and tear. Depreciation helps us to know how much we have lost of our non-current assets in the course of the trading period and even over the period that we have used the asset from the date of acquisition. We get to know the total asset wear and tear. So we're saying assets lose value through physical deterioration, wear and tear. Depreciation accounts for this natural loss of value due to regular use. Number 8, to account for obsolescence. To account for obsolescence. To account for obsolescence. Obsolescence is a loss in value either due to technological changes or due to the expansion of the firm. Technological expansion of the firm. What do I mean by this? I mean that, for instance, a very good example is computers. You may have a computer, it's not broken down, but it is being overtaken by very many other new generation computers which are able to do much more than the one you had. And therefore, it's not that it has worn out. It is not because of its wear and tear, but because of the regular and frequent technological changes. The same thing with the softwares. I like telling young people, I started using computers when we were using a software, an operating system, and a software called Lotus. We used to call it Lotus 1, 2, 3. That's how I learned my introduction to go. So technological changes or even the economic growth. A firm may be having facilities that are able to only manufacture 1 million items. But now it has expanded from Kenya to Uganda, Tanzania, and Rwanda and Burundi, and therefore it needs to manufacture 10 million. That factory of 1 million becomes completely obsolete. It cannot be used, it cannot help us. And therefore we find us forgetting all those machines, forgetting everything, and at times even bringing down the factory to build a much bigger factory. We are saying this obsolescence is classified as depreciation. We still classify it as depreciation, and we are able to predict. We may be able to predict within how long will our computers become irrelevant and spread the original purchase cost of those computers over that period of time. So we are saying technological advancements can make assets obsolete even when they wear out, even before they wear out physically. Even before they wear out physically, it is there. It has not been worn out. It is there, you can see it, but it is of no use to you. Depreciation helps to account for the loss in usefulness due to new technology or changing market demand. If we get a huge market demand and the machines we were using were producing very little, we will be forced to buy new machines, and the old machines may be of no use. To maintain capital intact, by charging depreciation, that is number 9, by charging depreciation as an expense, a business ensures that capital invested in assets is not consumed as a profit, preserving the original investment in the business. Number 10, to satisfy IAS 16 and legal requirement. I've touched something on IAS 16, but you're saying that in many countries, company law requires that depreciation be charged before profits are distributed to shareholders. Why do they demand that? To protect creditors and investors from false profit distributions. IAS 16 requires provision for depreciation and guides on how it should be computed. Number 11, to facilitate correct tax computation. To facilitate correct tax computation. Remember, depreciation in accounting, in terms of income tax accounting, is called capital deduction. It's called capital deduction, and it reduces the profits before we get the profit to charge tax. It reduces the profit before you get the profit to charge tax. So we're saying depreciation is an allowable expense for tax purposes. We call it capital deduction. It is an allowable expense for tax purposes. It reduces taxable profits, ensuring that the business does not pay tax on amounts not truly earned. If you don't charge depreciation or capital allowance, then the profit will be more, and because the profit will be more, the tax will be more. And therefore, it helps us to do something called tax shield. It's a tax shield. To ensure fair value in mergers or sales. To ensure fair value in mergers or sales. If you want to buy a farm, and it is recording its non-current assets at the original purchase cost. Imagine a non-current asset was bought 3, 4, 5 years, and its life is maybe 8, 9, 10 years, and it is being carried at its original purchase cost. It means if you bought it at the original purchase cost, you'll be lied to. So we are saying depreciation helps ensure fair value in merger or sales. When a business is sold or merged, accurate valuation of assets is essential. Depreciation ensures that assets are recorded at realistic values, aiding fair negotiations. Remember, we even talk about revaluation. And after revaluation, we start depreciating. Number 13, to support better decision making. We are saying depreciation helps management in analyzing profitability, cost control, and capital budgeting decisions, as it provides a realistic measure of asset usage and expense allocation. Number 14, depreciation helps to maintain consistency in financial reporting. Providing depreciation each year ensures consistency and comparability of financial statements across accounting periods. You can imagine a situation whereby you buy an asset and you charge it in the income statement immediately, and that asset will not just be used in the year it was charged. It will be used throughout its economic life. The year it was charged to reduce the profits, but the following years will have overstated profits. Number 15, to reflect the economic reality of the firm. Depreciation ensures that the financial statements represent the economic reality of using non-current assets or long-term assets, that their value declines over time as they generate revenue. Once again, I want to urge you, please, I want to urge you, ensure that you subscribe, share, like, and hit the notification bell so that every time we load this kind of videos and many other videos which are of great importance to you, you will be able to be informed. Thank you very much.